a client finished their sales month down 23% on the year in terms of sales, but their profit grew by 22% in the same month. How does that happen? That is what we're going to be unpacking today. Welcome to the Resilient Retail Game Plan. I'm Catherine Erdly, and this podcast is here to share retail industry trends, insights, and best practices for you, the retailer who's serious about building something that lasts. One of my favourite phrases, something that I like to wheel out from time to time, is the phrase, turnover's vanity, profit is sanity, and cash is reality. It is a cliche or an old business adage, but it is absolutely true. And what I find really fascinating about Stock Doctor and the results that we get for the clients is that we can really see that turnover's vanity, profit is sanity being played out in real time. If you want to know more about the Stock Doctor service, head over to stockdoctor.net where you can find out all the details and apply. So what I wanted to do is really delve into some of the client results and talk a little bit about how we can find ourselves in this situation where somebody is down on the year in terms of sales, but they are up on the year in terms of profits. So one of the things that we are taught, or one of the kind of accepted wisdoms in the business world, is that a big sales number in a month is a good number, and a bad month is if you have a small sales number. But I really do believe that is the vanity part. Most independent retailers were never taught to actually run their numbers, thinking about turnover's vanity and profit is sanity. And a lot of the time, what we're doing with our Stock Doctor clients is we are working on ways to really not just look at their sales. And it was actually quite unusual for this particular client to be down on the month against the year. But again, what we're really looking at is not so much are their sales going to be okay, but we're really looking at that bottom line, that profit. So top line revenue can hide things that really matter. Another example is a client that we worked with who had seen enormous growth in their e-commerce side. They're a bricks and mortar store. They also had an e-commerce website. They had huge growth on their online sales. And as a result, they had to really increase the amount of staffing that they had, people fulfilling online orders. But they also were actually less profitable after their sales had grown. So we delved into it and we dug into it. And what we found was that, as can sometimes be the case with e-commerce, especially if you're investing heavily in paid advertising, the cost of the advertising just wasn't offsetting, just wasn't washing its face. It was actually losing money after all of the costs of the products and after all of the costs of fulfilling them, the extra staffing, and so on and so forth. In terms of your actual business performance, yes, having these big numbers up on the year can be really exciting, but ultimately it can hide a lot of issues. It hides things like how much are you actually paying for those sales, how much are you paying for the stock that goes to creating those sales, and what are you left sitting on, what's unsold. It also doesn't really drill into how much did you outlay on stock, how much stock do you have tied up, which is basically cash just sitting there, instead of you being able to access that cash and have a healthy bank balance. So let's look in a little bit more detail into this particular instance of a client that was down on the year in terms of sales, but up in terms of profit. When we looked at the detail, what we found was the number of orders that they had were down 13%. So there were fewer transactions coming in. Now, typically, you wouldn't plan for this. You wouldn't be aiming to have fewer transactions. But what that was offset by was the fact that their average order value was up 21%. So even though they had fewer transactions, they already had seen an offset in terms of their sales by their average order value being up. We have to ask ourselves, what's better for you as a business owner? Fewer transactions with more money being spent on each one, or the same number of transactions but less money being spent? So, or indeed just everything staying level. It actually can be better for your business if you're taking fewer transactions, but each transaction is more valuable. The reason for that is that if you think about it, if somebody buys one item from you, it's actually not double the work for you to serve them or to bag up their product, to talk to them, serve them, take the payment, or if it's online, fulfill the order. If it's 2 items that they're buying instead of 1, it's barely any more work at all. So in other words, that transaction becomes more efficient when it's larger. So that's why average order value is something that I recommend that you really hone in on. So in this particular instance, They had slightly fewer transactions, and then they had actually got a higher average order value. So those two things combined meant that the profit was protected even though the sales were down. When you're looking at your sales going up, it's always useful to know, even if you're super happy with how your sales are going up, if you're thinking, wow, this is going really, really well, I'm really happy with this, it's always worth asking yourself, are the right things going up? Are your average order values also going up as well as your number of transactions? Are your costs also going up to fuel those sales, or are those sales happening organically? Or maybe your sales are up twice, but your costs are only up one time. That's fine. Just make sure that you're aware of it. Don't fall into the trap of thinking that, oh, well, as long as my sales are improving, that is the most important thing, because it's only one piece of the puzzle. So then let's come on to the next point, which is about profit is sanity. So this is where the crux of the performance came in. In this particular instance, the client's profit margin, or their sales margin, moved from 47.6% to 55.3%, which was a 22% gain on their profit. So that is a big swing, and it's not something that happens by accident. So how do you see your sales margin shift like that? There's lots of different pieces that go into it, but a lot of the time it's about a few different key areas. One of those is pricing discipline. In other words, making sure that your original price that you're setting to sell something at is going to be generating enough money. So in Tame Your Tiger, my book, I talk about the in margin and the out margin. So the in margin is the margin that you set when you are bringing a product into a business. So for example, if you are VAT registered and you are planning on selling a mug for £12 and you buy it for £5, then after you take the VAT off the £12, you would be left with £10 net, which means you had £5 cost and £5 profit, or in other words, you had a 50% profit margin. That is your in margin, because that's essentially theoretical. When you set the prices, you're setting it saying, I expect to be selling this at £12. So it's a theoretical in margin that we talk about, making sure that as the product comes into the business, you're setting the margin correctly. On the flip side, you have got what I call the out margin, and that's what we're really looking at here. So the out margin is the actual margin that happens once you've sold all of your products. So in this case, it went from 47.6% to 55.3%. So a big improvement in the actualized margin. Now, that has to start with your in margin. You have to set those prices correctly, because your out margin is always lower than your in margin. So your out margin is reflective of all of the discounts that you might have done. You might have had to mark some products down to clear them. You might also have needed to discount things. Maybe you offer a welcome discount or a locals discount. Maybe you do a short-term promotion. Whatever it might be, you will have some reason for discounting in your business. And so with your out margin, that is going to be reflective of that, and it is going to be lower than your in margin. So in this particular instance with this client, we've worked with them now for over a year. So this was a long-term project where we went and looked at all of the different aspects that was driving the profits. So one of those was the pricing discipline. There were some products that were underpriced. They were particularly underpriced when it compared to their margin. And so part of that work that happened to allow this performance where sales were down but profit was up, part of that was related to going and setting those prices correctly, reviewing them all, making sure that they were set correctly, making sure that the boundary was in place, that the business was set up for success. So that was the first piece. They had to look at the in margin, they had to improve that, and they had to make sure that that was ready to go, so that even when there were discounts, it was still going to be better than the pricing structure before. It's something that I've talked about a lot over time, but it is still something that a lot of people miss, making sure that every time you make a sale, you are making enough money, making sure that your profit margins are correct. So that accounts for some of it. Some of the reason that the profit margin was better was simply because the prices were corrected, reviewed and corrected. But that isn't the only thing that happened. There's also a lot of other active decisions, so buying tighter and more into the right categories so that this particular person wasn't left with the wrong kind of stock that they had to discount. Because they were really focused on only buying the stock that sold well and really cutting back on stock that didn't sell so well, they were able to focus on a real full price strategy and really drive sales without discounts. They also really lent into the products that their customer was telling them about. So last week's episode number 314, where I spoke to Stacey Dorian about the importance of data, we were talking about this exact idea that there are signals that buyers give you, that your customers are giving you about what they want to see more of, and signals that they're giving you about what they don't want to see as much of.
And it's how you react to those signals. Some signals are not the right ones and they're not right for your business, but knowing is that part in the middle where, like you say, it's a bit niche and you need that help to sort of like dive into it.
And if you're not looking at your data, you can miss those signals, which is why when we see people start to work with us on Stock Doctor, typically we do see sales increase, not just profit increase, because they are able to really focus in on the stock that makes a difference. So in this particular instance, the client that we're talking about here, it wasn't a magic solution. It was something that was very intentionally done over time where we fixed the pricing, but then we also fixed the product assortment so that we were selling more things at full price because we were really tuned into those buying signals. We were really understanding what it was that the customer wanted and doing more of that. And we were looking at the areas where the customer wasn't responding so much and we were pulling back on them, which meant that over time, those two things combined meant that the profit margin really increased because they were just simply selling more at full price of the things that the customers really wanted to see. They looked at their range, they really understood the different categories in their business, they understood where they needed to lean into and where they needed to pull back from, and that's how they were able to achieve this result. So it's also about keeping an eye on this over time, making sure that you're looking and responding to changing signals, because wouldn't it be great if the customer just gave really clear signals that stayed the same over time? But of course they don't do that. They change, they shift. And so a lot of the work that's done in Stock Doctor as well is the monthly updates, where the Stock Doctor is telling you, okay, well, this is what's happening this month. This is what we're seeing from the customer, and this is how it's shifting. And you can stay ahead of those shifts so you don't suddenly wake up one day and realize you've got a load of stock that the customer maybe wanted a couple of years ago, but has slowly over time been telling you has become less and less appealing to you. I think it's a really interesting example, this particular client example, because we hear this fairly often. If sales are down, I can't justify spending on stock support, or I can't justify spending on the analytics support, because what I really need to do is push my sales further. And of course, as I said, everything that we do in Stock Doctor is related to cash flow. So we are definitely looking at ways to grow your sales, and there's always a lot of great advice from our Stock Doctors who are extremely experienced in the retail industry on things that you can do, tactics that you can try. But equally so, I would just challenge you to say, is it more sales that you need, or is it more profit? So that is my challenge to you. Are you focusing on sales and the turnover is vanity part, or are you focused on profit and the profit being your sanity? This episode is brought to you by the Home and Gift Association, the new name for the Giftware Association. The home and gift industry is evolving, and so are they. The Home and Gift Association brings together brands, retailers, suppliers, and innovators across the home, gift, and stationery sectors, helping businesses make valuable connections, discover new opportunities, and stay ahead of what's happening in the industry. If you're looking to grow your retail business, they've got an exclusive offer for Resilient Retail Game Plan listeners. You can join for retail membership for just £49 until the end of the year with no joining fee, saving you £99. Membership includes networking events, retailer and buyer introductions, expert business support, industry insights, awards, promotional opportunities, and access to a fantastic community of home, gift, and lifestyle businesses. To find out more, head to homeandgiftassociation.org.uk and use the code RESILIENT49 RESILIENT49 to claim your exclusive listener offer. That's homeandgiftassociation.org.uk and the code is resilient49. So the third part of that saying, cash is reality, is where we really see the benefit on Stock Doctor as well, because this is where we have seen some incredible results. For example, we have a client who has £900,000 less stock than last year and are still trading level or slightly up. And as you can imagine, if you think about the amount of money that has freed up that they haven't been spending on stock, then that also is hugely, hugely beneficial on cash flow. And again, another area where we see for Stock Doctor clients that they're seeing this additional profit, but they're also seeing this freeing up of their cash flow. So cash is the part that actually keeps the lights on, and stock is where cash goes to die. Not to be too dramatic about it. So for example, that particular client has a very extreme example of bringing down stock that was unproductive and doing it in a way that didn't damage the brand. And now they're in a position where they've got a much healthier stock position. It's so much lighter than where it was a year ago. It is a huge reduction. It is something that allows them to free up the physical space, the mental space, as well as the financial space to really reduce the amount of stock that they have. And then also the benefit that it has to be able to invest into new stock is huge as well. Often when we have the monthly updates with Stock Doctor clients, we're looking at the stock number. Is it still coming down? Is it turning fast enough? We're looking at stock cover, and we're working with people. Effectively, the whole name of the game is how little stock can you have while still maintaining and growing your sales? And that's the question that everyone is trying to work out all the time. What is that sweet spot? What is that number that will allow you to support your sales growth, but equally turn your stock faster? Because we look at the number of weeks cover, which is the number of weeks worth of stock in the business that we have based on an average weekly sales for the next 12 weeks coming up. That is a really good indicator that helps us understand how a business is turning their stock. And we're always looking to try and improve that, because for every week's improvement in terms of the number of weeks cover, that is a huge impact on the cash flow. If you think about it, the faster you turn your stock, the more cash there is in the business. So for Stock Doctors, we're always looking at ways to improve that target cover, to speed it up, and to identify what we call the clogs of stock in the business to really help move through it. The number of weeks cover is really the number that tells you whether or not your stock is working for you or trapping your cash. And turnover doesn't tell you this. Profit doesn't really fully tell you this either. So that's where you also need to look at your stock turnover, because that is the reality of running your business. As we all know, we need to have money in the bank to be able to pay our bills, to be able to pay people to support us, to be able to pay ourselves for all of the hard work that we put into our businesses. What we often see in terms of Stock Doctor, because it is a service that pays for itself, the great thing about running a service where we track all the numbers is that we can see categorically that after 6 months, people see on average 10% more sales with 10% less stock, which equates to £5,000 worth of extra profit per 100k of revenue. And it sounds too good to be true. It's something that actually pays for itself. We also see when people work with us over a year, that actually improves even further. So we see on average 17% more sales with 14% less stock. So it compounds over time. And what we can really see with that, and the reason it pays for itself, is because often the answer to I need more sales is not to buy more stock. Often, sometimes the answer is you need to buy less stock, you need to spend less money so people are able to tighten up their budgets, as well as also the benefit of having that real confidence and clarity in the business, because you've got a stock expert who's going through everything in your business, all of the information, and telling you what you need to do to move forward. So we're very big on things like making sure that you've got a to-do list at the end of each session with a Stock Doctor, so that you just know, okay, if I do these 5 things this month, this is going to help me move the profit forward in my business. And of course, to get to those 5 key tasks, the Stock Doctor has done a huge amount of deep dive analysis. Some people love to delve into the detail as well. Some people just want to know, what are the 5 to 10 things I need to do in my business this month to grow my sales, to grow my profit, to reduce my stock holding and improve my cash flow. So it's often about freeing up cash that is currently sitting on shelves. It applies especially when your budget is tough. If you feel in your gut that your business should be more profitable than it is, then Stock Doctor will help you really maximize that. And that's what we're seeing. People spending less money on stock, spending it in a better way, really understanding their data, just like I talked about in last week's episode with Stacey, and being able to make better business decisions. So bringing it back to this idea of turnover is vanity, profit is sanity, cash is reality, I think this is a great guiding principle for all retailers to think about. If you do nothing else, 3 things that you can always look at are: what are my sales this month? What is my profit this month? What's happening to my margin? Is it moving in the right direction? And how much stock am I sitting on? And again, if you feel like this is something that you would love to delve into, but you just know yourself you do not have time, then head over to stockdoctor.net. You can find out more about the service and apply. Thank you so much for listening. I really appreciate you tuning in, and I would love it if you could rate or review the podcast wherever you listen to your podcasts. And of course, if you like, follow or subscribe, you'll be the first to know about each new episode. Comes out every Thursday morning, and we'll see you next week when we'll start talking about that all important in the retail calendar, which is Christmas.